Tom Lee is here. He has a new call for a gain of 100 points or more in the S&P in the next week. This all has to do with expectations of a lighter than expected CPI reading. Tom Lee is co-founder of Fundstrat Global Advisors and a CNBC contributor. You started the year more bullish than anyone. I saw the articles last week that I was referencing that you were the one bull that was talking about 4,700 on the S&P. So this isn't, you're not late to the party like so many of these people that, I love analysts that, you know, they have a Netflix, they have a neutral on Netflix and a price target of 170, and then they raise their price target to 400, and they act like, you know, like no one's going to remember. So you were there early. This is not something you typically do, though. A 1 week call, short term, for a 3%, 2.5%, 3% move in the averages.
Yes, that's right. You know, markets move a lot around the CPI report, so that's always a big market event. And we thought a tactical sort of opportunity was emerging because last week the market sold off because the jobs reports are strong, yields really popped. So investors are kind of fed higher for longer, a little bearish into this week. And I think core CPI could come in at 0.2 or better. So it could be a huge downside surprise.
0.2 or lower, you mean? When you say better, you mean it could
yes, 0.2 or lower than 0.2.
Yeah.
And
that is way out of where it's been, and people aren't expecting that.
Correct. It'd be the lowest since August of 2021. So it's a huge break of pattern, almost a 2-year low. And it would show that the Fed is getting inflation to levels like on a monthly basis that they're trying to target. I mean, a 0.2 is 2.5% annualized, and it might even be repeatable. You might see similar numbers for the next couple of months, and that would, I think, push short-term rates down and trigger a pretty major rally in the equity markets.
Also, it has to do with used car prices, which in the last 2 months have been, everybody talked about an outlier, but you also had a statistic about how many of the components are actually in a deflationary trend, and it's like 55% versus historically, that's very rare to have that many of the components in a deflationary trend.
Correct, yes.
What are those numbers that you...
So, yes, on a weighted basis, 42% of the CPI basket is in deflation right now, meaning the price was higher sometime in the past 18 months.
Wow.
And the long-term average is 30%. The 10-year average is 38%. So this is already far higher than what you would expect. So future inflation should fall, and that's with shelter still rising at 8%. So when shelter starts to flatten out, that's going to take that number to 70% or more.
Hey, Tom, overnight, China had some deflationary numbers for producer prices. Consumer prices were weaker than anticipated, and it had people wondering if there was real concerns about the economy, if there's a downturn there. So how quickly does good news from a weaker CPI become bad news?
It could, based on the market mood. Sometimes the market narrative can flip. But the weak PPI in China, it is kind of adding to a disappointing reopening story for them. But the good news is, you know, China PPI and U.S. PPI are kind of correlated. So I think it does mean it's going to feed over into the U.S. as lower prices, either better profit margins for the S&P or lower CPI.
You also raised your year-end target for the S&P recently, right?
Yes, yeah, we did that a few weeks ago.
The 48 and
25, yeah.
48, 25. Earnings season is coming. Everyone's saying that, you know, consensus, Wall Street Journal, other places, it's going to be a rude awakening for people when they see earnings. And also the recent backup in yields. Rude. This is a hated market. This is not, what you're saying flies in the face of consensus again.
That's right. I think there's a lot of entrenched skepticism. I think some of that will get shattered on Wednesday with CPI. But on earnings, the reason earnings aren't doing better is because of energy. Energy is now going from adding to earnings this quarter to actually a 25% drag. Excluding energy, S&P earnings are up year over year. So it's the first positive year over year ex energy since first quarter 2022.